Hello students, I am Shilpa Agrawal, your faculty for today's mentoring session. Today's mentoring session is on Paper-1, Financial Reporting, Major Changes in Indian Accounting Standard vis-a-vis existing accounting standards. Before starting up the session, I would like you all to please note the following disclaimer slides. Students are advised to refer to the study material, including supplementary study material, if any, and other relevant legislation for latest provisions, amendments required for forthcoming examination. They are advised to refer to e-lectures available on the students' LMS for this and other topics. These lectures are freely accessible. You just have to log in with your student registration number and start learning. Till date, we have covered following Indian accounting standards or we have covered following topics in our mentoring session after completion of November 2015 examination. From January onwards, we have started taking mentoring sessions on those topics which are new and are applicable for May 16 examination for the first time. So first two mentoring sessions were devoted to the topic accounting and reporting of financial instruments. We have conducted two mentoring sessions for this topic. Later on, we shifted to Indian accounting standard. This topic is also applicable for May 2016 examination for the first time. First mentoring session on this topic was covered roadmap and carve-outs in Ind AS from IFRS. Then from February onwards, we have started with the differences in Ind AS vis-a-vis existing accounting standards, and we have tried our level best to cover all the Indian accounting standards and the differences thereon. Till date, we have covered, in February, we have covered 5 Indian accounting standards, and till March, we have covered almost 7 differences in Indian accounting standards vis-a-vis notified AS. Today because today's mentoring session is for 2 hours, we'll be trying to cover at least 7 to 8 Indian accounting standards and the differences vis-a-vis their respective notified accounting standard. So let's start with Indian accounting standard 24, related party disclosures vis-a-vis notified AS 18, related party disclosure. Both the standards, that is the standard in this Indian accounting standard and existing accounting standard, the name is same, that is related party disclosure. However, the number in Indian accounting standard is in accordance to IFRS, that is International Accounting Standard 24. The number given here is Ind AS 24, that is related party disclosure, and the comparison which we are going to make today for this standard is with notified AS 18, related party disclosures. The first difference which we will start is on definition of relative. Since we are talking about related party disclosure, so first of all, see what are related. So first thing which comes is relatives. So as per existing AS 18, the term relative use all blood relations besides spouse. Spouse is not a blood relation, but that is a direct relation. So besides spouse, all blood relations are covered in as relatives of an individual in AS 18, existing AS 18. That blood relations comes from son, daughter, that is direct blood relation, you can say. Son, daughter, brother, sister, father, and mother, who may be expected to influence or be influenced by that individuals in her dealings with the reporting enterprise. It means it may be that the influence is intentional, that they are expected to influence, they are trying to influence you to do this type of dealing, to do this or enter into particular transaction in this particular manner. That type of influence can be made by the relatives, or you are indirectly influenced. It's not that they are influencing you by verbally saying something to do, but the act or the action taken by them may influence you to do the same thing in the same manner, or the similar type of thing in the same manner in our dealings or in your dealings. So relatives of an individual as per existing accounting standards includes spouse, son, daughter, brother, sister, father, and mother. That's all. It's the limited definition which covers number of people. However, in Ind AS, Indian Accounting Standard 24, the term is not used relative of an individual. The term uses a close member of the family of a person. By giving the term a close member, we have tried Indian Accounting Standard, the formula, those who have tried to formulate the standard, those who have formulated the standard, we have tried to give wider scope to the definition and try to include people who are not only in blood relation but who are directly or indirectly in your blood relation or somewhere where they can influence you. For example, they have included in their definition of close members of family children, spouse, children, domestic partner, brother, sister, father, and mother. This is blood relation. Children, besides spouse and domestic partner, children of that person's spouse or domestic partner, dependent of that person or that person's spouse or domestic partner. Hence, the definition as per Ind AS 24 is much wider. They have not only included the person who are in your blood relation directly, but also the person or the individuals who are in your blood relation indirectly. Not only those who are in your blood relation, but also those persons who are your spouse relatives or spouse related to your spouse or domestic partner in one or the other way, like children or a dependent. They are also included in the definition of a close member of the family of a person. So in that way, we can say the definition is much wider, much broader. It includes persons not directly in blood relation. So definitely the scope or Ind AS 24 is more vast and covers more people as relatives or a close member of the family of a person. Second difference is state-controlled enterprise. In Ind AS 24, it is not only central government or state government which are considered as state enterprise, which are under the control of central government or state government will only be considered as state controlled enterprise as per existing AS 18. However, in Indian Accounting Standard 24, the state controlled enterprise is not limited only to central government. The control power is not limited to central government or the state government. The control power may be vested with and jointly controlled or significantly influenced by a government, or what we can say government agencies or similar bodies, whether local or national or international. Means as per AS 18, enterprises will be defined as state controlled enterprise only when they are under the control of the central government or any state government. However, as per Ind AS 24, an entity will be considered as state control enterprise or control government related entity. In fact, the terminology is not state control enterprise. The terminology is government related entity. When it refers to the government agencies, similar bodies, whether local, national or international. So government may be central, may be state government may be government agencies or similar bodies, maybe municipal corporations, maybe any associations or ministry, whether local, national or international, they will be referred as government. So government related entity are the entity that is controlled jointly, controlled or significantly influenced by a government. So the definition has included not only the control but also significant influence. Let me just mark out few words. Pen portion, please. Okay, let's see it. So, as per Ind AS 24, government-related entities are the definition itself has been modified. Instead, the terminology has been modified. Instead of state-controlled enterprise, we have used the terminology government-related entity, and the definition of government has also been wider by not only including central government or state government, but also the government agencies and similar bodies, but also whether it's local, national or international. And also the control which is there in AS 18 The control which is there in AS 18 has now been in Ind AS 18 is not limited only to control, it is limited to jointly controlled or significantly influenced by a government. That will also be considered as government related entity. Sorry. The third difference is for key management personnel. As per as per existing AS 18, key management personnel of the entity covers key management personnel of the entity only. So, key management person of if I am an entity, for me, a related party will be a key management personnel of my entity only. However, for Ind AS 24, key management personnel may be of not only of your entity but of the group also, the parent as well. For example, it also covers the entity or any member of a group. So key management personnel is not only a person, it will be an entity or any member of a group of which it is a part, providing key management personnel services to the reporting entity or to the parent of the reporting entity. So, as per existing AS 18, if I am entity say A, I am A Limited, then for me, any key management personnel will be a person who is related to my entity only, who is giving me services for providing me key management personnel services to my entity. However, as per Ind AS for A Limited, if A Limited is a subsidiary of B Limited, A Limited is a subsidiary of B Limited, then this B Limited is a holding company. So any key management personnel for B Limited may also be treated as KMP for A Limited. Any person dealing in B Limited may be treated as KMP or key management personnel for A Limited. So B Limited or an employee or any director or any member shareholder of B Limited who is B Limited, since B Limited is a parent company of A Limited, either B Limited or any employee of B Limited will be considered as the key KMP for A Limited. The next difference is related parties in case of joint venture. Under Ind AS 24, there is extended coverage in case of joint ventures. Two entities are related to each other in both their financial statements if they are either co-venturers or one is a venturer and other is an associate. However, as per existing AS 18, no such definition is given. Nothing has been mentioned like co-venturers or co-associates are related or not related to each other. So as per generally we say as per existing AS 18, co-venturers or co-associates are not related to each other because nothing has been mentioned regarding their relation. So as per the definition or as per the standard, something which we have mentioned that these are the related parties, then only we'll be considering them as related party. So if nothing is mentioned in the standard, we won't consider it as related party. So if nothing is mentioned regarding co-venturers or co-associates, so it is assumed as co-venturers or co-associates are not related to each other. However, this has been specifically mentioned in Ind AS. This has been specifically mentioned in Ind AS 24 that there is an exception. So, for example, A Limited is a joint venture done by two entities, say X Limited and Y Limited. Now, one of the co-venturer of A Limited is associated with B Limited as a co-venturer, and it also has an associate. This is a venturer. And they have one, say for example, T. They are having T Limited and T Limited is an associate of B Limited. In such a case, B Limited will be considered a related party of A Limited or T will be considered a related party of A Limited. This is as per Ind AS 24. However, since co-venturers and co-associates are not related to each other in existing AS 18, so they will not be, either B Limited or T Limited will not be considered as related party to A Limited or Y Limited, X Limited. But as per Ind AS 24, they are all said to be interlinked, and therefore they all will fall in the purview of related party as per Ind AS 24. Effect of influences which do not lead to transactions. This is another difference. There are certain influences which are executed by one entity or one person or to an entity, but that influence will not lead to any transition. Then in such a case, what should be done, as disclosure should be made or not. So existing AS 18 mentions that where there is an inherent difficulty for management to determine the effect of influences which do not lead to transactions, disclosure of such effects is not required. This is mentioned in AS 18 that such disclosures are not required. However, as per Ind AS 24, when something has not led to any transaction, so that influence or the effect of influence cannot be determined or can be determined is not required. So they does not specifically mention this. When there is no transaction involved because of non-determination of the effect of influence involved, then there is no need to discuss or mention anything on that. So Ind AS 24 has kept silent. They have not specifically mentioned that whether disclosure is to be made or not. So when they are silent, it means no disclosure will be made. Nobody is going to disclose on their own part. Therefore, whatever is given in Ind AS, you comply that only. That will be compliance of those disclosures is a difficult aspect. So nobody is going to do an extra disclosure. So if nothing is mentioned in Ind AS 24, then no disclosure will be made by any person or any board of directors or the accountant and all. So as per existing AS, it is specifically denied that disclosure of such effects is not required. Ind AS 24 has not mentioned about this, but indirectly it says that yes, disclosure will not be made. Nobody is going to make the disclosure on their own. But nothing has been mentioned. This is a difference they have specifically mentioned, and Ind AS 24 does not mention this. Next difference is post-employment benefits. Existing AS 18 does not specifically cover entities that are post-employment benefit plans as related parties. So they says they are not specifically dealing. AS 18 is not dealing with such post-employment benefit plans, whether they are to be considered as related party or not. If an entity is running any post-employment benefit plans or are in agreement with some post-employment benefit plans, so those post-employment benefit plans will be treated as related party or not. As per existing AS 18, no, they will not be treated as related party. However, because nothing has been dealt in existing AS 18, however, in Ind AS 24, it specifically includes post-employment benefit plans for the benefit of employees of an entity or its related entity as related parties. So as per existing AS 18, since nothing has been mentioned, we can also assume it, or we can also conclude that post-employment benefit plans are not related parties. However, specific mention is made in Ind AS 24 that they are related parties. They have to be treated as related parties. Disclosures has to be made by treating them as related parties. Next difference is Ind AS 24 vis-a-vis notified AS 18. This is next most senior parents, or in short we can say NMS. So Ind AS 24 requires an additional disclosure. Since related party transactions, nothing is about accounting. The whole standard is about disclosure. So here we are talking about additional disclosure. Ind AS 24 requires an additional disclosure as to the name of the next most senior parent, which produces consolidated financial statements for public use. Existing AS 18 has no such requirement. It means if an entity is owned by or controlled or is a subsidiary, suppose A Limited is the holding company of B Limited, and B Limited has acquired C Limited. C Limited has further subsidiary which is D Limited. Okay, in that case, when D Limited is preparing its financial statements, so as a related party, since D Limited is a subsidiary of C, C is a subsidiary of B, and B is a subsidiary of A, it means they all three will be combined when A, which is a parent company, will be preparing a CF, consolidated financial statement. So, when D Limited is preparing its own financial statement, then as a related party, next most senior parents for C Limited, it's a parent, D Limited is a subsidiary, it means C is a parent company or a holding company. Next most senior parent is B Limited. So D Limited, while preparing its financial statements, will present B Limited or A Limited as NLSP, next most senior parent, and they'll treat it as a related party, and additional disclosure regarding this next most senior parent will have to be made in their financial statement. However, existing AS 18 has no such requirement. Sorry. Disclosure for compensation. Ind AS 24 requires extended disclosures for compensation of key management personnel under different categories. Existing AS 18 does not specifically requires this. It means compensation of KMP means remuneration or the payment which we are making to KMPs. It also includes remuneration or compensation paid by an entity to key managerial personnel. Extended disclosures is required under Ind AS 24 under different categories. Which person falls in which category? So direct, what we say is a full-time KMP or a part-time KMP or whatever. You have to, in different categories, you have to mention whatever the remuneration or compensation has been paid to it by an entity. Existing AS 18 does not specifically require this. They say that the compensation of KMP has to be disclosed, but extended disclosure, under different categories, disclosures has to be made. This all has not been mentioned in existing AS 18. Sorry. Next difference is disclosure of amount of the transactions versus volume of the transaction. Ind AS 24 requires the amount of transactions need to be disclosed. However, existing AS 18 gives an option. It's not only the amount which has to be disclosed, they give option either you disclose the amount or you disclose the volume. So the option is given either to disclose the volume of the transaction or either as an amount or as an appropriate proportion. Third option is also given, that is appropriate proportion. This appropriate proportion means, for example, the transaction between an entity and related party is about, say, 550 transactions, which resulted into 50 amount of 50 lakh value. So, as per Ind AS 24, you have to simply mention 50 lakh amount is the value of the transaction between the entity and related party. However, existing AS 18 says either you say 50 transaction or you say 50 transaction of rupees 50 lakhs in total, or 50 transaction of rupees 50 lakhs in aggregate. 50 lakh divided by 50, it comes to 1 lakh per transaction. You can proportionate it and you can mention in either of the form, either 50 lakh, either 50 transactions of 1 lakh per transaction value. You can disclose it in either of the manner. Next is government related entities. Ind AS 24 has a specific or detailed guidance for government related entities. However, existing AS 18 presently exempts the disclosure of such information if an entity is a state controlled entity as per existing AS 18. See, existing AS 18 is using the terminology state controlled entities. So as per existing AS 18, any transaction with state controlled entities or government related entities is not required to be disclosed in your financial statement as related parties. Not that the transaction is not required to be disclosed. The transaction has not to be disclosed as related party transaction. It can be disclosed simply in a manner which you do it in your financial statement, but they will not be disclosed as related party transaction. However, as per Ind AS 24, they also exempt you. They say that requires disclosure of certain information by the government related entities. They say yes, it should not be as related party, but you have to disclose certain information under Ind AS 24 itself regarding government related entities like amount, like the transaction, nature, effect and all. But yes, it will not be as related entity, but under Ind AS 24 only you have to make certain disclosures, which is not there in your existing AS 18. Next difference is clarification of control, substantial interest and significant influence. See, we have also seen in your previous slides where we have mentioned it's not only control, it's a joint control or significant influence. Specifically, this we have dealt when we were dealing with state control entities. These terms have been used there for being relative or for being considered as a related party. It's not only the control which will define that you are a related party transaction, it's also substantial interest in another entity or substantial interest of another entity in your entity or any significant influence. These all three will also be considered as as criteria for considering an entity or the other party as related party, and their transactions between them or with them will be disclosed in your financial statements. So existing AS 18 includes definition and clarificatory text primarily with regard to control. And if it is your substantial interest including 20% threshold, significant influence including 20% threshold. Ind AS 24 neither defines these terms nor it includes such clarificatory texts and allow respective standards to deal with the same. So regarding what is control, what is substantial interest, what is significant influence, what are the criteria to define, this has not been mentioned in AS 24. These has been mentioned in different standards which specifically deals with control, substantial interest or significant influence. Like for significant influence, we have a standard on associates. Associates, this relationship emerges when there is significant influence. So the definition of significant influence is dealt in that standard which relates to investment in associates or accounting of associates. So same definition has not been repeated in Ind AS 24. However, though in existing accounting standards, significant influence is a term mainly used for associates and has been dealt in existing AS 23, but that has been re-mentioned here in existing AS 18 also, that significant influence means including 20% threshold. Likewise, substantial interest also for them, they have mentioned this 20% threshold. This is there in some other standard, repeated here also. Control, definition of control is there in some other standard in AS 21 and all, but has been repeated here also. But some clarificatory text or explanations have been given regarding this, but Ind AS 24 does not give any clarificatory text in AS 24 regarding control, substantial interest, significant influence, because these terminologies or definition of these terms have been dealt in different standards, different Indian accounting standards. So one can refer from that standard. So next standard, before moving to next standard, let's see if we have some online queries. Okay, we are not having any online query on this, so we'll move forward to next standard. Our next standard is Ind AS 28, investment in associates and joint ventures, vis-a-vis notified AS 23, accounting for investment in associates in consolidated financial statements. So Ind AS 28 says investment in associates and joint ventures, but we are making comparison only with in notified AS 23, which deals with accounting for investment in associates. We are also having a standard in existing accounting standards. We are having a separate accounting standard for joint ventures. But this joint venture we are not comparing here. Maybe with associates we may come across some differences, but the differences are made here. Differences are made here only with we have comparison we have made here with notified AS 23. Again, we are moving to first difference. First difference is generally for definition part. In the existing AS 23, significant influence has been defined as power to participate in the financial or operating policy decision of the investee, but is not control over those policies. In AS 28, the same has been defined as, or significant influence has been defined as, power to participate in the financial and or operating policy decisions of the investee, similar definition, but is not control or joint control over those policies. The extra terminology which is used here is or joint control. So the definition here Ind AS 28 has more specific, has more clearly given the boundaries to what is significant influence. If control is individually, the control is not there to an entity, but that control can be exercised by jointly, then it will not be considered as significant influence. It will be considered as joint control only. For example, A Limited is acquiring B Limited by 60%. A Limited has acquired 60% shares of B Limited and B Limited has acquired 40% shares of C Limited. Further, A Limited has also acquired 20% shares of C Limited. In such a case, what will be the treatment of A Limited? Will it be treated as will C Limited will be treated as associate of A Limited, or will C Limited be treated as subsidiary of A Limited? Because subsidiary, because we are saying 20% is acquired by A Limited, 40% is acquired by B Limited. So since B Limited is a subsidiary, 60%, so it is a subsidiary. But another view is that C Limited can be also treated as associate. How associate? A Limited is acquiring 20%, that is stable, that is there, but we cannot take 40% directly. What we have done, 60% of 40%. Indirect proportion we have taken and it came to 24%. So, sorry, this came to 24%. So 24 plus 20 became 44%. So it is less than 50%. So there is no control. You say if this is less than 50%, there is no control. This is no. Here control is not individual but joint. Joint control is there. 20 plus 40%. When you are influencing B Limited, the minority's power has gone here, because now you are the 60% who are dominating this 40% also. So this 40% is jointly controlled along with 20%, making C Limited a subsidiary. So here, when it becomes C Limited, it becomes subsidiary, or the significant influence is nowhere exists. There exists control. Significant, so the definition of significant influence will not be complied here as per the standards. So in short, I would like this type of example. I have given my RTP also. Many of them have even raised a query also whether C Limited to be treated as associate or joint venture. Let me tell you one thing very clearly. Arithmetical calculations does not define the relationship as subsidiary or associate. Is the power which you are exercising, is the control which you are exercising on the third entity, which will define or which will establish the relationship as subsidiary or as an associate, not the arithmetical calculation. So by arithmetical calculation, you say it's 44% indirectly. No, that is not going to define the relationship. Arithmetical calculations are just for calculation purpose, but the power or control is not limited or is something beyond that arithmetical calculation. So here jointly you are controlling C limited, so you are not significantly influencing it, you are controlling it. So the definition of significant influence or definition to consider it as an associate is left beyond, and you have reached to control. So Ind AS 28 has specifically mentioned joint control, though in our existing standards also it will not be considered as significant influence because the power to exercise control is there, but nothing has been specifically mentioned as joint control. Control includes joint control but has not been specifically mentioned in our existing standard 23, but in Ind AS 28 they have been more vocal, more specific, more clear on this issue. Next difference is potential equity shares. As per the existing AS 23, for considering share ownership for the purpose of significant influence, potential equity shares of the investee held by investor are not taken into account. What are potential equity shares? Potential equity shares are the shareholders, are the future shareholders, those who are not the shareholders in the current scenario but will be shareholder in the future scenario. For example, you have a convertible debentures. Those debentures will be converted into equity shares some over the period of time or in the particular specific future date. In that case, that convertible debentures will be considered as potential equity shares to the extent it will be converted into number of equity shares. So those potential equity shares of the investee will not be taken into account for considering the share ownership for the purpose of significant influence. However, Ind AS 28 says that yes, that potential voting rights has to be considered while determining significant influence, whether it's casted on an entity or not. For that, you have to consider the existence and effect of potential voting rights that are currently exercisable or convertible that are currently exercisable. If something is currently exercisable or convertible, that effect or existence of those potential voting rights are to be considered for determining significant influence. As per Ind AS. Another difference is equity method. Existing AS 23 requires application of the equity method only when the entity has subsidiaries, prepares consolidated financial statements. So if you are having a subsidiary, then you will be definitely preparing a consolidated financial statements. And when you are preparing your consolidated financial statements, so any entity which is not subsidiary but an associate, that associate has to be accounted in your consolidated financial statement as per equity method. However, Ind AS 28 says for preparation of consolidated financial statements, it is not required that you have a subsidiary. It means a consolidated financial statement will be prepared if you are having an associate or joint venture. This is the requirement given in Companies Act 2013 as well. In Companies Act 2013 also, you have to prepare a consolidated financial statement if you are not having subsidiary but you are having a joint venture, or you are having a associate, or you are having both but not subsidiary. Still you have to prepare consolidated financial statement. However, this does not have changed the AS 23 right now. Let me tell you certain amendments. This is off the table. I am saying you certain amendments have been made in your existing accounting standards rules 2006. Recently those amendments have been made in the month of March. They have been notified, where there were anomaly between Companies Act and the standards. They have tried to remove it. So Because of that difference, it may be that the difference between Ind AS 28 and existing AS 23 has also been done away, because existing AS 23 has been rectified on and the amended version has been notified, but that amended version has not been made applicable for May 16 examination. They will be applicable maybe from November 16 examination. So since it is not applicable for May 16 examination, the difference will persist here and you have to study this difference. The equity method for difference for equity, application of equity method. However, maybe in November 16, the status of this difference changes, or may I say that this difference no more exists. But as per for May 16 examination, you have to study this difference, and as per this difference, Ind AS 23 says you have to apply equity method only when an entity has a subsidiary and they prepares consolidated financial statement. However, Ind AS 28 says even if the investor does not have any subsidiary, you have to prepare consolidated financial statement, and therefore the application of equity method will be made whether there is subsidiary or not, because they are saying they require application of equity method in financial statements other than separate. It means they have to make it in consolidated financial statements only, but it is not necessary that they have subsidiary. It is necessary that they prepare CFS. Then application of equity method has to be done. Next difference is exemption from applying equity method. Right now we have seen the difference that when to apply equity method in Ind AS 28 or in AS 23, but there are certain exemptions from applying equity method. Kindly excuse me, and because of some throat problem, maybe certain pauses are there. Next difference is exemption from applying equity method, where the associate operates under severe long-term restrictions that significantly impair its ability to transfer funds to the investee as per the existing AS 23. So this difference is that if you are having an associate, but that associates operates under severe long-term restriction, it means you have invested in a particular entity, and because of that entity is your associate, but you are not able to mobilize your funds, or there are certain significant they impair its ability to transfer funds to the investee. You are not able to transfer funds because of certain restrictions. Because of certain restrictions. In such a case, application of equity method is not required. However, such type of assumption is not provided in Ind AS 28. Ind AS 28 does not give such exemption. Under such situations also, Ind AS 28 says that you have to apply equity method. However, AS 23 exempt you under such situation for application of equity method. Next, explanation of the term near future. This is also one of the exemption for applying equity method. The term near future used in another exemption from applying equity method, that is where the investment is acquired and held exclusively with a view to its subsequent disposal in the near future. This explanation has not been given in Ind AS 28. In existing AS 23, let me tell you friends, earlier we were having accounting standards interpretations. Later on, when accounting standards were notified by the Companies Act 1956 as Companies Accounting Standard Rules 2006, accounting standards interpretations were merged as an explanation to your accounting standards, and they were not mentioned as a different series of accounting standard interpretations. So the explanation or clarification or interpretation of near future was there in accounting standard interpretation, which has now been merged as an explanation to accounting standard. Likewise, in Indian accounting standard also, what we do is, if you go to IFRS, you will find international financial reporting standards and their interpretations of international financial reporting standards. But when we have notified Indian accounting standards, so when we notified Indian accounting standards, so when Ind AS were notified, at that time all the IFRICs or interpretations on international financial reporting standards were incorporated in Indian accounting standards itself as in the form of appendix. So we do not have interpretations of Indian accounting standards till date. We are having interpretations incorporated as appendix. Likewise, of similar manner, this was done in 2006 also. Certain accounting standard interpretations were merged with accounting standards in the form of explanation to the related paragraph. The near future, this was also an interpretation which is now included as an explanation to the existing standard. This explanation is there in existing AS 23, but is not there in Ind AS 28. Ind AS 28 does not deal with such term near future or such restrictions because this is dealt by Ind AS 105. In Ind AS, they are very clear. If something is dealt specifically with by any other standard, no need of repeating the same thing in the another standard. But in existing standards, if something is dealt again with some other standard, again the definition is repeated, though the same definition, but is repeated again. That repetition has been avoided in Indian accounting standard. If you have to refer that definition, go to the respective standard. So near future is there in AS 23, but not there in AS 28 because in Indian accounting standard, near future is dealt in 105 and not in Ind AS 28. Next difference is measurement of investment. That has an investment in an associate, a portion of which is held indirectly through venture capital organizations or a mutual fund, unit trust, and similar entities, including investment-linked insurance plans. So in short, we can say ULIPs. Unit-linked insurance plans. So Ind AS 28 permits that an entity that has an investment in an associate, a portion of which is held indirectly through venture capital organizations or a mutual fund, unit trust, and similar entities, including ULIPs or investment-linked insurance funds, to elect to measure that portion of investment in the associate at fair value through P&L in accordance with Ind AS, when that will be considered as financial asset and will be considered valued as per Ind AS 109. Regardless of whether these entities have significant influence over that portion of the investment. For example, A Limited has a significant influence in B Limited by 45%. Now, in actual, A Limited has acquired only, say, 22%. Or say less than 20%. Say, sorry, 18%. They have acquired only 18%. Out of 45, if 18 is acquired by A, then how a B Limited became the associate of A? Maybe A Limited has invested in a mutual fund or in a venture capital organization wherein these mutual funds have invested in B Limited. Or these venture capital organizations have invested in B Limited. So I have invested somewhere in mutual fund and mutual fund have invested say 15% here and 20% here. So this 15%, this 20%, this 18% combined will determine the significant influence. Maybe percentage wise does not tell you with this. This 35 plus 18 is, sorry, take it as only 5. 25 plus 18 is 43%. Take it as 43%. Don't tell you the percentage, just an example I'm giving you to explain that significant influence may not be directly acquisition of shares by you to in another entity. That acquisition may be indirectly through mutual fund, trust, or venture capital organizations or ULIPs. That will also be considered for your significant influence, and the measurement of however those indirect terms, indirect investments will be through as per Ind AS 109. Irrespective of that, your investment has led to 5%. Mutual fund may have more investment in B Limited that has led to their significant influence, but still your investment will be valued as per AS 109. This has been mentioned in Ind AS 28. But nothing regarding this has been given in the existing AS 23. Another difference is investment classified as held for sale. Again, because we have in Indian accounting standards, we have a separate standard on on a separate standard on for held as sale or for discontinued operation. There is a separate standard which is Ind AS 105, which deals with such type of assets. So, Ind AS 28 requires a portion of an investment in an associate or a joint venture to be classified as held for sale, and if the disposal of that portion of the interest would fulfill the criteria to be classified as held for sale in accordance with Ind AS 105. If the disposal of that portion fulfills the criteria as per Ind AS 105, then as per Ind AS 28 also, that portion of investment in an associate or joint venture will be classified as held for sale. So here you have to not refer Ind AS 28 separately or in isolation. You have to refer it with reference to Ind AS 105. If that disposable portion is in line with Ind AS 105, so classification will be same. What is there in Ind AS 105? That same classification will continue in Ind AS 28. However, nothing has been dealt in existing AS 23 regarding this such type of classification or for such type of portion of investment. Another difference is application of equity method in separate financial statements. In AS 28, the same is to be accounted at cost or in accordance with 109 financial instrument, because you are making an investment, it is a financial asset for you. So Ind AS 28 says either treat it as financial assets and deal as per 109, or accounted at cost. Option is given there, but in existing AS 23, no such option is given. It has to be accounted in separate financial statements in accordance with existing AS 13. Why existing AS 13 and not as financial asset or financial instrument? Because we do not have any notified accounting standard on financial instrument in existing accounting standard. AS 30, 31 and 32 are encouraged to be followed. They have not been notified. They are not even recommendatory in nature. They are encouraged to be followed. So whenever you see the weightage of notified standards are always more than the standard which is encouraged to be followed. So it is mentioned that as per existing AS 13 only, you have to account such investment in a separate financial statement. Next is difference in reporting dates. Now see, whenever more than one separate financial statements merge and you prepare a consolidated financial statement, so the separate financial statements of two different entities have to be in the same line, or to be on the same line. Whether it's date, whether it's accounting policy, anything, they should be in uniformity. So the one of the difference is the difference in reporting date. Both AS 23 and Ind AS 28, they both says that the reporting date should be same when you are consolidating the financial statements of associates with you, but with a parent company. But but existing AS 23 permits the use of financial statements of different date of the associate drawn up to a date different from the date of financial statements of the investor when it is impracticable to do so. In such a case, they accept the financial statement of associate of whatever date it is. They have not given the limit of difference. However, Ind AS 28 says if it is impracticable to do so, then also the difference in the reporting date of a parent company and the difference in the reporting date of associate should not be more than 3 months. For example, Parent financial statements is drawn on 31st March, say 16. Associates financial statements are drawn on 30th September 2015. The difference is of 6 months. So, in case it is impracticable to do so, they will what existing AS will do, they will accept it. However, if it comes to Ind AS 22 or implementation or following application of Ind AS 28, they will say no. If it is not possible to draw for 31st March 2016, then draw at least for 31st December 2016. Sorry, 31st December 2015. At least the difference should not be more than 3 months. Okay. But if under existing AS 23, if the difference is more than for 3 months, still will accept it if it is impracticable to do or to draw another financial statement of the same date. Next difference is on accounting policy. Similar type of difference. In reporting date also we were looking for uniformity. Similarly for accounting policies also we'll be looking for uniformity. In case an associate uses different accounting policies for like transactions, for similar transactions, appropriate adjustments shall be made to the accounting policies of the associate. It means financial statements of an associate has to be redrawn based on the similar accounting policies which is followed by the parent company. However, if it is not possible to do so, the fact shall be disclosed along with a brief description of the difference between the accounting policies. Ind AS 28 provides that the entity's financial statement shall be prepared using uniform accounting policy. This is as per existing standard also for like transactions and events in similar circumstances, unless in case of an associate it is impracticable to do so. Appropriate adjustments shall be made. The existing AS 23 provides for it is not possible to make adjustments. You have to, the fact shall be, the additional disclosures are to be made, but such additional disclosures are not mentioned for Ind AS 28. This simply says that okay, if you cannot draw this, okay, what we do so. So Ind AS 28 provides that entities' financial statements shall be prepared using uniform accounting policies for like transaction and events, unless it is impracticable to do so. But no disclosures has been mentioned for that or specified for in such a situation. Next difference is share in losses. As per existing AS 23, investors' share of losses in the associate is recognized to the extent of carrying amount of investment in the associate. It means if you are having any loss in your investing enterprises, A Limited has acquired say 40% in B Limited. B Limited is an associate. Now you are suffering some loss from B Limited. That loss is to be recognized in your CFS by applying equity method, but that loss should not be more than your investment or the carrying amount of the investment. If the carrying amount of the investment is say 1 lakh, then your losses should also be limited to 1 lakh only. It means in the balance sheet you have to show your investment in associates at nil value, but not at negative figure. However, in Ind AS 28, this carrying amount is not only the use, but here you have to include long-term interest that in substance form part of the entity's net investment. Long-term interest means irredeemable or preference shares which are not to be redeemed in near future, convertible debentures or something long-term loans which are not convertible or not to be discharged or redeemed in near future. They will form part of carrying investment, and the total of that will be taken into consideration to determine how much loss to be accounted and at what value are by what value of investment in associates to be shown in your CFS. Next difference is impairment loss. With regard to impairment, the existing AS 23 requires that the carrying amount of investment in an associate should be reduced to recognize a decline other than temporary in the value of investment. So AS 23 says that impairment should be done. If you are having any investment, your investment in associate should be considered as long-term investment, and that investment will be declined or impairment will be accounted only when that difference is other than temporary or is a permanent difference. But Ind AS 28 requires that after application of equity method, including recognizing the associates or joint ventures losses, the requirements of Ind AS 109 shall be applied. It means you have to treat it as a financial asset, so you have to account it as per 109 fair value through P&L. Whether it is after that, if there is any necessity to recognize additional impairment loss, then you have to recognize it. But that impairment loss has to be determined only after application of Ind AS 109. However, in existing AS 23, no application of financial instrument or Ind AS related to AS related to financial instrument is to be taken place before determining the impairment for such type of investment in associates. Before moving to next standard, let's see if we have any query. Okay. Please explain appropriate proportion 9 difference. See, student, I have already told you appropriate proportion where you have to disclose your related. This is, I guess, with related to in existing AS 18. Okay. In our AS 18, we say either you have to report it in volume or in absolute or in the amount or in appropriate proportion. Appropriate proportion means your aggregate amount of transaction with the related party has to be appropriate or has to be averaged out. That is appropriate proportion between AS 18. That is the difference of appropriate. That disclosure of appropriate proportion is the option given as per existing AS 18, and this option is not given in your Indian accounting standard. They say that you have to recognize only the amount of the transaction, but in the existing AS 18 states that either you recognize the amount or the value or the volume or the appropriate proportion. Means if you are having 50 transaction of 5 lakh rupees each, so either you mention it in this manner or you say you are having 2.5 crore transaction with the related party, or you say we are having 50 transactions with the related party. This type of disclosure is to be made. So appropriate proportion means transaction value divided by the number of transactions. So let's move on to our third Indian accounting standard. Third Indian accounting standard which we are going to cover today is Indian accounting standard 33. Ind AS 33, earnings per share vis-a-vis notified AS 20 earnings per share. There are only 3 differences in this standard. First difference is options held by the entity on its shares. Ind AS 33 deals with options also. Sorry. Ind AS 33 deals with options also. Options held by the entity on its shares. Such guidance on such transactions is there in Ind AS 33. However, existing AS 20 does not provide any specific guidance on this. Does not specifically deal with options held by the entity on its shares. Example, purchase option, that is call options, written or put option. Ind AS 33 deals with the same, or there is a guidance or appendix given on this. Second difference is presentation of basic and diluted earnings per share from continued and discontinued operations. Ind AS 33 requires separate basic earning per share for continuing operation, basic earning per share for discontinued operation. Similarly, diluted earning per share for continuing operation, diluted earning per share for discontinued operations. However, AS20 does not require such type of disclosure. This is we have to prepare basic and diluted EPS, whether it's from continuing or discontinuing operations. That is as an entity as a whole. Entity as a whole, you have to disclose basic and diluted EPS. Third difference is disclosure of EPS with and without extraordinary items. See, student, from the day one we are where when we have started taking mentoring sessions on differences between Ind AS vis-a-vis existing accounting standard. In our Ind AS 1 differences, we have mentioned the concept of extraordinary item has been done away in Indian accounting standard. There's no more such type of concept. They do not deal with any item. They do not treat any item as extraordinary item. So whenever existing accounting standard talks about extraordinary item, you will find a difference vis-a-vis Indian accounting standard, because Indian accounting standard does not talk about extraordinary items. They do not believe that they are anything which can be termed as extraordinary. So disclosure of EPS, existing AS20 says or states that you have to disclose EPS with extraordinary items and without extraordinary items. However, since there is no concept of extraordinary items, so Ind AS 33 does not require the aforesaid disclosure. So you have to simply disclose EPS of an entity. Everything is with whatever the expense or whatever the transaction has taken place. Nothing is without any item. These three differences are there only in Ind AS 33 vis-a-vis AS 20. So today we have covered three standards. Now the fourth standard is Ind AS 34 interim financial reporting vis-a-vis notified AS 25 interim financial reporting. The first difference is of scope. Under the existing AS 25, if an entity is required or elects to prepare and present an interim financial report, it should comply with that standard. Ind AS 34 applies only if an entity is required or elects to prepare and present an interim financial report in accordance with Indian accounting standard. So, see, try to understand this. This is quite tricky. Existing AS 25 is saying, I am not saying that you prepare interim financial report. If you are preparing interim financial report, then that report should comply with the standard. So, standard is not mandating to prepare interim financial report. It's only saying if you are preparing financial statement because of SEBI regulations, because of the requirements given in Companies Act or whatever, if you are preparing and presenting interim financial reporting, then please follow please follow existing AS 25. Ind AS 34 says, if an entity is required or elects to prepare and present financial statement in accordance with Indian accounting standard, then apply me also. So they are saying, if you are preparing and presenting financial statement in accordance with Indian accounting standard, then apply this me also, apply Ind AS 34 also. So here things are approached or sorry, things are viewed in a different manner. They says I do not mandate. Existing AS 25 does not mandate you to prepare any interim financial report. But if you are preparing, then please follow existing AS 25. As per Indian accounting standard, if you are preparing and presenting interim financial report in accordance with Ind AS, Ind AS is saying you to prepare interim financial report, then please follow existing Indian accounting standard 34. Ind AS 34 is not mandating you. But they are saying if you are preparing because of any other Indian accounting standard, or your financial statement is prepared in accordance with Indian accounting standard, then you have to apply me also, or you have to apply Ind AS 34 also. Consequently, it is specifically stated in Ind AS 34 that the fact that an entity may not have provided interim financial reports during a particular financial year or may have provided interim financial reports that do not comply with Ind AS 34 does not prevent the entity's annual financial statements from conforming to Ind AS if they otherwise to do so. What does this mean? If, see, Ind AS 34 is saying if you are preparing on account in accordance with Indian accounting standard, then follow Ind AS 34 also. If you are not preparing in accordance to Indian accounting standard, then no need to follow this also. It means interim financial report can be in accordance with Indian accounting standard or may not be in accordance with Indian accounting standard. When it is not in accordance with Indian accounting standard or not in accordance with Ind AS, in that case, what will be the treatment for annual financial statements? Here, Ind AS is making it very clear whether your interim financial report is in accordance with Indian accounting standard or not in accordance with Indian accounting standard. Your annual financial statement has to be in accordance with Ind AS. You cannot avoid preparing your annual financial statements without application of Indian accounting standards if you are preparing your financial statements or you are mandated to prepare as per Ind AS. So, exemption to prepare your interim financial report by applying Ind AS may be there, but exemption to prepare your annual financial statements without applying Ind AS is not there. You have to, in any case, you have to prepare your annual financial statements in accordance with Indian accounting standard, whether or not you prepare your interim financial reporting in accordance with Ind AS. So, your interim financial reporting, whether Ind AS or not. Annual financial statement always as per Ind AS if you are following Ind AS. If you are following existing AS, then as per AS. If you are following Ind AS, then as per Ind AS. Complete set of financial statements. In Ind AS 34, the term complete set of financial statements appearing in the definition of interim financial report has been expanded as compared to AS 25. Since in Ind AS 34, when you are preparing complete set of financial statements, you have to prepare the financial statement of at the beginning of the preceding period, which was not there in existing AS 25. AS 25 simply says you have to prepare balance sheet, you have to prepare profit and loss, you have to prepare cash flow statement, that is whatever was there as part of financial statements. We have to prepare notes to accounts. But in AS 34 says as a financial statement or a component of financial statement, complete set of financial statements, not you have to prepare immediate balance sheet as at the beginning of the preceding period. In annual financial statement, you use this balance sheet as at the beginning of the preceding period when an entity applies an accounting policy retrospectively. For example, if your reporting date is, say, 31st March 2016, in such case, your preceding financial period will end on 31st March 2015 and the beginning of the preceding period will be 1st April 2014. So your one financial year, preceding financial year will be starting from 1st April 2014, ending on 31st March 2015, and your current year will be starting from 1st March 2015, sorry, 1st April 2015, and ending on 31st March 2016. So you have, as per Ind AS 34, if you are making any retrospective application of any accounting policy, then you have to prepare the balance sheet on this date also. So one balance sheet will be on this date, one balance sheet will be on this date, and one balance sheet will be on this date. So similarly, you have to prepare interim financial report in which your balance sheet will be on this date, and this date as well. If you are applying any accounting policy retrospectively, or your retrospective restatement of certain items has been done, or reclassification of item has been done, or comparative information of the respective preceding periods are required as per Ind AS 1. So In such a case, you have to prepare this balance sheet also. You have to prepare the balance sheet on 1st April of the 2014 as given in the example. This is the difference between Ind AS 34 and AS 25. AS 25 does not require to prepare your opening balance sheet of 1st April 2014. But Ind AS 34 says that yes, in interim financial report also, complete set of interim financial report or financial statement will include this balance sheet also. Next is contents of interim report. As I told you, the amendment has been made in existing notified accounting standard. Recently, that amendment has been notified, but is not applicable for you for May 16 examination. Maybe for November 16 it is applicable. So this difference may be done away with, but is applicable. This difference is there for May 16 examination. As per the existing standard, the contents of an interim financial report includes at a minimum condensed balance sheet, condensed statement of profit and loss, condensed cash flow statement, and selected explanatory notes, but does not include condensed statement of changes in equity, which forms part of interim report as per Ind AS 34. However, after change in the accounting standard rules 2006 amendment 2016 made in 2016, statement of changes in equity forms part of financial statements. So this may form part of interim report as well. So this difference may done away with. But not applicable for May 16. The difference will persist in May 16, may be removed for November 16 examination. Next difference is reversal of impairment loss. Ind AS 34 includes Appendix A, which addresses the interaction between the requirements of Ind AS 34 and the recognition of impairment losses on goodwill in Ind AS 36 and certain financial assets in Ind AS 109, and the effect of the interaction on subsequent interim and annual financial statements. So Ind AS 34 prohibits reversal of impairment loss recognized in previous interim period in respect of goodwill. That impairment loss should be in relation to goodwill or investment in either an equity instrument or financial asset carried at cost. So one thing is goodwill, second is investment in either an equity instrument or financial asset carried at cost. If you are impairing such assets, then the reversal is prohibited. However, such prohibition is not there in existing AS 25. Next difference is inclusion of the parent separate statements and the consolidated financial statement in the entity's interim report. Under the existing standard, if an entity's annual financial report included the consolidated financial statements in addition to the separate financial statements, the interim financial report should include both the consolidated financial statements and separate financial statements, complete or condensed. So as per existing standard, if an entity's annual financial report include consolidated financial statements, so if you are preparing your financial report, your annual financial report is CFS, in addition to SFS, separate financial statement, then interim financial report should include both CFS as well as SFS, complete or condensed. Ind AS 34 says if you are preparing CFS, then option to prepare separate financial statement is, but they do not prohibit they do not require or nor prohibit the inclusion. If you are preparing CFS as per Ind AS 34 in an annual financial statement, then for interim financial reporting, Ind AS 34 is silent. They say that they neither require to prepare interim financial report based on separate financial statements or prohibits the inclusion of parent separate statements of entities. They are silent. It's completely the choice of the entity what to do. Next, differences of accounting policies. The existing standard requires the notes to interim financial statements, if material and not disclosed elsewhere in the interim financial report, to contain a statement that the same accounting policies are followed in the interim financial statements as well, and the case of change in those policies, a description of the nature and effect. So this is the requirement in Ind AS 34 as well. You have to make a statement that the same accounting policies are followed, and if same accounting policies are not followed, then description and nature and effect of the description of the nature and effect of the change has to be made. Ind AS 34 also requires these two. In addition to these two, Ind AS 34 further states that in case of change in the accounting policy, besides describing the nature and effect of the change, you have to also describe the method of computation in case of change in accounting policy. So, as per Ind AS 34, in case of change in accounting policy, description shall be of three things: nature of the change in accounting policy, effect of the change, and method of computation. However, as per existing AS 25, description will be of nature and effect in case of change of accounting policy. Next is dividends. The existing standard requires furnishing information in interim financial report of dividends, aggregate or per share in absolute or percentage terms for equity and other shares. Excuse me. The existing standard requires furnishing information in interim financial report of dividends, aggregate or per share in absolute or percentage terms for equity and other shares. Ind AS 34 requires furnishing of information in interim financial report on dividends paid, aggregate or per share separately for equity and other shares. So, existing standard says simply disclose this information or about regarding dividend. The dividend, for suppose say you are declaring dividend of ₹5 lakh. This dividend is for equity shares and others. For equity shares and other shares, maybe preference shares. No? However, Ind AS 34 says you cannot say lump sum amount. You have to specifically define how much is for equity shares and how much is for other shares. Maybe say suppose 4 lakh is for equity shares, 1 lakh is for other shares. So you have to define it carefully. So requires furnishing of information in interim financial report on dividend paid, aggregate or per share separately for equity and for other shares. Maybe I'll show it in value or per share value, whatever, but have to be separately for equity shares, separately for other shares. Next difference is contingent liabilities and contingent assets. Contingent liabilities. Existing standard requires furnishing of information on contingent liabilities only. They say if you have any information regarding contingent liability, disclose it in your interim financial reporting. However, if you have any information regarding contingent asset, then disclose it in your other report, director's report, or in your notes accounts. No need to disclose it in your financial statements. However, Ind AS 34 requires furnishing of information on both contingent liabilities and contingent assets if they are significant. If it is not significant, then in that case you may skip disclosure of contingent assets. But if disclosure of contingent assets is significant, then you have to disclose it in your as an information. You have to furnish that information. Again, the differences on extraordinary items by terminology, you can mention it clearly. Ind AS will not be dealing with extraordinary items, so the comparison exists or difference exists. In comparison to AS 25, reference to extraordinary items in the context of material is deleted in Ind AS 34, which is in line with Ind AS 1. Next difference is interim financial statements prepared on complete basis, where an interim financial report has been prepared in accordance with the requirements of Ind AS 34. That fact should be disclosed. Further, an interim financial report should not be described as complying with Ind AS unless it complies with all of the requirements of the Ind AS. The existing standard does not contain these requirements. Existing standard does not say that you have to comply with all existing standards. This says if you are preparing financial report, interim financial report, please then follow AS 25. But interim in Ind AS 34 it says that if you are preparing interim financial report based in accordance with other Ind AS, then follow Ind AS 34 as well. It means all the requirements of all the Ind AS, the requirements of all Ind AS has to be complied simultaneously, so that interim financial report is said to be complied with Ind AS. This statement is applied when your financial statements are prepared on complete interim financial statements are prepared on complete basis. If interim financial reports are prepared on condensed basis, then such requirements are not required. Next difference is change in accounting policy. Under the existing standard, a change in accounting policy other than the one for which transitional provisions are specified by a new standard should be reflected by restating the financial statements of prior interim periods of the financial year. For transitional provisions, different treatment are given. That treatment is no need to be required to be restated or to be done from the previous years. Besides the changes due to on account of transitional provisions, any other changes made, change in accounting policies are made, then that change in accounting policy has to be accounted retrospectively, should be reflected by restating the financial statements of prior interim periods of the current financial year. This is as per the existing standard. However, as per Ind AS 34, additionally, Ind AS 34 additionally requires restatement of the comparable interim periods of prior financial years that will be restated in annual financial statements in accordance with Ind AS 8, subject to specific provisions when such restatement is impracticable. So, generally, Ind AS 34 also states that if you are changing an accounting policy, that has to be retrospective and you have to restate your financial statements of prior interim periods. Besides this requirement, Ind AS 34 additionally requires, this is additional requirement which makes the difference. Ind AS 34 additionally requires restatement of the comparable interim periods of prior financial years that will be restated in annual finance. Suppose you are preparing your financial statements, interim financial report for say June quarter. You are because of change in accounting policy, you are reinstating your prior period items. You are reinstating last March wala quarter or January or December wala quarter, but correspondence to that December quarter, any previous financial year's quarter will also be compared or restated. That is the additional requirement as per Ind AS 34. Next is impact of convergence. Convergence of all other standards with IFRS also has impact on interim financial reporting. For example, treatment of constructive obligation in Ind AS 37. ETC will have impact in interim financial reporting, which could be different in the context of relevant existing standard. There are other consequential impacts also. For example, existing AS 20 requires EPS with and without extraordinary items. Since the concept of extraordinary item is no longer valid in the context of Ind AS 1, the question of EPS with and without extraordinary item does not arise in the context of Ind AS 33. This changed requirement of Ind AS 33 is equally applicable to interim financial reporting. So whatever the difference we have studied till now in Ind AS 34 vis-a-vis AS 25, which relates to difference in the standard will also apply not only to financial statements, annual financial statements will also apply to interim financial statements. May I tell you whatever the difference which we have studied till date in any other Indian accounting standard with notified accounting standard, or we'll be studying in the coming mentoring sessions regarding Indian accounting standard with existing or notified accounting standard, those differences will persist and will be continued and have to be taken care of while preparing your interim financial report, or those differences will continue for interim financial report or will be applicable in interim financial report as well. For example, constructive obligation as per Ind AS 37, the treatment of constructive obligation in Ind AS 37 will impact interim financial reporting, but that is not given in your AS 29, so will not impact the interim financial report prepared as per AS 25. Similarly, when you are preparing your when you are calculating EPS as per AS 20, you have to calculate EPS or disclose EPS with or without extraordinary items. So when you are preparing interim financial report, your EPS as per AS 22 will be with and without extraordinary item. But the difference will continue in interim financial report also. Your interim financial report based on Ind AS 34 will not contain EPS with or without extraordinary item. It will be everything will be with the whatever items transactions has been done. Sorry. Next difference is transitional provision. Under the existing standard, when an interim financial report is presented for the first time in accordance with that standard, an entity need not present in respect of all the interim periods of the current financial year a comparative statements of profit and loss for the comparable interim periods, current and year to date of the immediate. So certain transitional provisions are given in existing AS 25 because existing AS 25 came into picture in long back but was notified in 2006. So certain transitional provisions were given. But Ind AS 34 when came, they were made applicable. So there are no such transitional provisions in Ind AS 34. Before moving to next standard, let's see we have any queries. We are not having any query. So we move on to next standard, that is Ind AS 36 impairment of assets vis-a-vis notified AS 28. First difference is financial assets. See, this difference is these standards are on impairment of assets. So first of all, what are assets which can be impaired? The definition of asset or the assets as per AS 28 which can be impaired and assets as per Ind AS 36 which can be impaired, they are different. As per Ind AS 36, certain financial assets which can be impaired are investment in subsidiaries, investment in associates, investment in joint ventures. These are investments, these are financial assets and they can be impaired. However, as per existing AS 28, they do not impairment does not apply to such type of assets because we have a separate standard for investment in subsidiaries, investment in associates or investment in joint ventures and accounting treatment thereon. So we do not, AS 28 does not deal with these standards and does not state that impairment provisions will apply on these such type of assets. Next is biological assets. Ind AS 36 specifically excludes biological assets related to agriculture activity because we have a separate Indian accounting standard 41 on agriculture. So whatever the treatment regarding biological assets are there is there with Ind AS 41. So, but impairment is not done on such biological assets. So they exclude this within their scope. Existing AS 28 does not specifically exclude biological assets. They do not have any biological asset concept because we do not have any standard on agriculture. So does not nothing has been no specific exclusion regarding biological asset has been made in existing AS 28. Disclosures. Ind AS 36 requires certain extra disclosures as compared to the existing AS 28. Sorry. Ind AS 36 requires certain extra disclosures. As you all know, definitely disclosure part is more in Indian accounting standard vis-a-vis or in comparison to existing standard. So this is the case with Ind AS 36 vis-a-vis existing AS 28 also. Disclosures are more in Ind AS 36 in comparison to existing AS 28. Additional guidance. Ind AS 36 gives additional guidance on inter alia the following aspects compared to the existing AS 28. Estimating the value in use of an asset for managements to assess the reasonableness of the assumptions on which cash flows are based using present value techniques in measuring and assess value news. Since Ind AS 36 are said to be more transparent, more clarity is involved, more guidance are given in Indian account, any Indian accounting standard. Similar is the case with Ind AS 36 as well. In Ind AS 36, regarding certain extra guidance, additional guidance has been, these concept has been dealt with in AS 28 also. However, additional guidance, more clarification has been given in Ind AS 36 on these concepts. The concepts like estimating the value in use of an asset for managements to assess the reasonableness of the assumptions on which cash flows are based using present value techniques in measuring and assess value in use. Such on these topics, additional guidance has been given by Ind AS 36, but limited guidance is there in existing AS 28. Ind AS 36 vis-a-vis notified AS 28, one of the differences, reversal of goodwill. Existing AS 28 requires that the impairment loss recognized for goodwill should be reversed in a subsequent period when it was caused by a specific external event of an exceptional nature, that is, not expected to recur, and subsequent external events that have occurred that reverse the effect of that event. Suppose there are certain specific external event of an exceptional nature. Generally, in general, it does not occur, but it came into picture. So that reason that caused the impairment of goodwill that came out. However, later on, another specific event came into the picture which has reversed the, which recur and subsequent external events that have occurred that reverse the effect of the earlier event. Suppose event A happened. This was exceptional in nature and this has led to impairment or loss of goodwill. This led to impairment loss recognized for goodwill. Later on, another event happened, which is event B happened. This event B reverse the impact of event A. In that case, existing AS 28 states that impairment loss on goodwill should also be reversed. However, Ind AS 36 prohibits the recognition of reversal of impairment loss for goodwill. Ind AS 36 prohibits the recognition of reversal of. So, in any situation, once you have impaired the goodwill, that impairment will not be reversed. If that impairment relates to goodwill, if that impairment relates to any other asset, then reversal may be the case. But when it relates to goodwill, the impairment loss will not be reversed. However, as per AS 28, such impairment loss may be reversed based on the event which led to impairment has been, that event has been, another event has reversed the impact of the earlier event, then that reversal can take place. Next difference is impairment testing for an intangible asset with an indefinite useful life. Ind AS 36 requires annual impairment testing for an intangible asset with an indefinite useful life or not yet available for use and goodwill acquired in a business combination. Generally, in notified standard, in fact, I should refer you here AS 26, which we'll be covering in the next difference, which the standard which we are going to cover in the next part. So in the coming session. Sorry, in this session, in the coming part, AS 26 states that intangible assets always have indefinite useful life. There is a repeatable assumption that it has an indefinite life, but for accounting purpose, we amortize it for a certain year, so say 5 or 10 years. But Ind AS 36 requires annual impairment testing for an intangible asset with an indefinite useful life or not yet available for use and goodwill acquired in a business combination. So they say if you have not used any asset till date, but still you have to do impairment testing, annual impairment testing. You have to do the annual impairment testing on such assets. You have to do annual impairment testing on goodwill acquired in a business combination. So first thing here is asset which is having indefinite useful life. Second is asset available for use. Third is goodwill acquired in a business combination. So on 3 parts, annual impairment testing has to be done as per Ind AS 36. Existing AS 28 does not require the annual impairment testing for the goodwill unless there is an indication of impairment. So that mandate requirement of annual impairment testing is not there in existing AS 28, but they says if there is indication of impairment, yes, then you have to do the impairment testing. But this does not mean that you have to do annual impairment testing, but yes, indication of impairment if exists, then you have to do impairment testing as per AS 28. Next difference is bottom up and top down test. In the existing AS 28, goodwill is allocated to CGUs only when the allocation can be done on a reasonable and consistent basis. If that requirement is not met for a specific CGU under review, the smallest CGU to which the carrying amount of goodwill can be allocated on reasonable and consistent basis must be identified and the impairment test carried out at this level. So first you have to see that for goodwill is allocated to CGUs. CGUs are what? Cash generating units. For cash generating units, goodwill is allocated only when allocation can be done on reasonable and consistent basis. If allocation has not been done on reasonable and consistent basis, in that case, whatever is the leftover portion, when all a portion of goodwill cannot be allocated reasonably and consistently to the CGU, that leftover being tested for impairment. Whatever we cannot allocate it to cash generating unit on reasonable or consistent basis, that leftover amount of goodwill is tested for impairment. And for that testing, we follow 2 levels of impairment tests are carried out. That impairment 2 level of impairment tests are carried out. Those 2 level tests are bottom up test and top down test. In Ind AS 36, bottom up test and top down test. In Ind AS 36, goodwill is allocated to cash generating units or groups of CGUs or cash generating units that are expected to benefit from the synergies of the business combination from which it arose. There is no bottom up or top down approach for allocation of goodwill. In Ind AS 36, goodwill is not that they have to do it on reasonable or consistent basis. The approach for allocation of goodwill to cash generating unit or groups of cash generating unit is that they are expected to benefit from the synergies of the business combination. If that CGU is expected to be benefited, then goodwill is allocated to that CGU. Therefore, this bottom up or top down approach is not followed. What is bottom up or top down approach? Bottom up approach is from where you see the least valuable asset and then we come to upper, and top to down you go to the main assets, then come down to leftover portion, then which is left to goodwill. So this standard simply is bottom up and top down test is done basically in AS 28 for allocation for impairment of goodwill which we were not able to allocate it reasonably and consistently on consistent basis to CG. However, Ind AS 26 does not follow these 2 approaches. They says allocation of goodwill is done on the synergy basis. Which out of business combination, whatever the synergy arises, that synergy is the basis for allocation of goodwill. And when there is, in such a situation, goodwill is always allocated fully and nothing is left over. So no need of such tests to be done. Let's move on to our online portal and see. We are not having any queries, so we are moving to another standard. We are left with less time, and the difference in this coming standard is more. We are going to have now, for at least for 15 minutes, we have to cover the standard, which is having number of, sorry, we are having two standards. One standard we may be covering, however, we won't be able to cover Ind AS 38. We'll be covering Ind AS 37 today because we are left with only 15 minutes. But Ind AS 38, which carries number of differences, we will be covering in the coming session. Ind AS 37, provisions, contingent liabilities and contingent assets, vis-a-vis notified AS 29, provisions, contingent liabilities and contingent assets. First difference is constructive obligations and change in the definition of provisions and obligating events. The AS 29, existing AS 29, states requires creation of provisions arising out of, let's start reading from here. Existing AS 29 requires creation of provision arising out of normal business practices, customs and desire to maintain good business relations or to act in an equitable manner. This normal business practice, which is an outcome of the action or which is an outcome of normal practices, general practice which was followed by an entity, not because of any verbal commitment, just because of the action taken by them or the custom or desire to maintain good business relations. This is there in AS 29. This is there in AS 37 also. But in Ind AS 37, the terminology given to such type of normal business practices, customs and desire is given constructive obligation. For this becomes the definition, this becomes the terminology. When constructive obligation is a terminology used for creation of provision, is that constructive obligations are the obligations which are outcome of normal business practices, customs and desire to maintain good business relations or to act in an equitable manner. Definition was there in AS 29, but terminology was not there in AS 29. Ind AS 37 introduced this terminology, constructive obligation. When they have introduced this terminology, they have given the definition also. They have made the difference between differences between legal obligation and constructive obligation. So the difference arises because there is no such terminology used. Constructive obligation, though definition has been used or this has been explained or this concept has been covered in existing AS 29, but the terminology has been not used. The definition has not been made, has not been specifically marked out, highlighted. So it became a difference, that constructive obligation and change in the definition of provisions and obligating event on account of constructive obligation. So let me read this difference. Unlike the existing AS 29, Ind AS 37 requires creation of provisions in respect of constructive obligations also. However, the existing standard requires creation of provisions arising out of normal business practices, customs, and a desire to maintain good business relations or to act in an equitable manner. This has resulted in Ind AS 37 in some consequential changes also. For example, definitions of provision and obligating event have been revised in Ind AS 37 because of introduction of constructive obligation, while the terms legal obligations and constructive obligations have been inserted and defined in Ind AS 37. The concept was used in AS 29 also, but specifically not defined. That definition has been provided in Ind AS 37. Next difference is discounting provisions. See, provisions as per AS 29 or in the Indian scenario, we generally treat it as short-term provisions. We generally treat them as short-term, current. That's why we do not believe in discounting of those provisions. However, now concept is changing. Its provisions may be short term, maybe long term also. When the concept of long term also is added to provisions, so discounting is also possible. So existing AS 29 has not been changed. They prohibits discounting the amount of provisions. However, Ind AS 37 requires discounting the amounts of provisions if effects of the time value of money is material. That means if that provision is for more than a year, the time value is there and that time value in fact is material, then discounting is allowed or is required as per Ind AS 37. However, AS 29 completely prohibits discounting, whether it's time value, whether it's for long term or whatever, they prohibits discounting. Third difference is disclosure of contingent assets. Existing AS 29 notes the practice of disclosure of contingent assets in the report of the approving authority. Generally, who is the approving authority is generally board of directors. So, in the report of the approving authority, but prohibits disclosure of the same in the financial statements. Ind AS 37 requires disclosure of contingent assets in the financial statements when the inflow of economic benefits is probable. The disclosure, however, should avoid misleading indications of the likelihood of income arising. So, generally, the concept of prudence says that anticipation of losses is to be accounted in the books, but the anticipation of income are not. So, if anticipation, contingent assets are what? Anticipation of future income. Sorry. So, anticipation of future income may mislead the picture of your financial statement. The one has to be very cautious while disclosing it in the financial statement. Ind AS 37 requires disclosure of contingent assets in the financial statement, but to be very cautious, by being cautious, they says when the inflow of economic benefit is probable. Probable here it means more than rare. It is probability is that they are much of chance that it will be materialized, that we will be receiving something, that contingent assets is going to be materialized, then only you have to recognize it in financial assets, though it is an anticipation of income. But one has to be careful that that recognition or disclosure of financial asset, contingent asset in your financial statement may not lead to misleading indications of the likelihood of income. However, AS 29 completely says that in financial statement you cannot. They prohibits disclosure of the same in the financial statement, but they says you can disclose it in the report of the approving authority. Next difference is on onerous contracts. First of all, understand what are onerous contracts. An onerous contract is a contract in which the unavoidable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under it. In which unavoidable cost of meeting the obligations. Unavoidable cost, it means you have till date incurred say 10 lakh rupees. Unavoidable cost to meet the contract, maybe say further you are going to meet 5 lakh rupees. Total will be 15 lakh rupees is the cost to incur to establish or to fulfill the contract. Meeting the obligation is 15 lakh and the contract exceeds the economic benefit. The contract value is only 12 lakh rupees. So your cost of obligation is more than the benefit, exceeds the benefit by rupees 3 lakh. So this 3 lakh makes this contract onerous contract. So Ind AS 37 makes it clear that before a separate provision for an onerous contract is established, an entity should recognize any impairment loss that has occurred on asset dedicated to debt contract in accordance with Ind AS 36. So in a contract, if you are constructing anything, any asset, you are building any asset, you are developing any asset, and that asset, impairment of that asset has to be also taken in care of while recognizing the provision for those onerous contracts. For before making recognition of this 3 lakh rupees, you have to see the contract which was undertaken is to develop an asset. That develop, say asset is of rupees, asset will be recognized at fair value of 20 lakh. So whether this 20 lakh is the value or it has declined to say only 18 lakh. If this asset has been impaired, then that you have to set up this impairment with this provision, and then only you have to recognize the provision for onerous contract. However, AS 29 does not deal with such type of provisions. So whether we have to see the impairment loss on the assets dedicated to that contract, no such provision is there. We deal with onerous contract, we deal with provisioning for such onerous contracts, but we do not deal with the impairment of the loss that to be taken into account on assets dedicated to that contract while recognizing the provision for onerous contracts. That is not dealt in AS 29. Future operating losses. The existing AS 29 states that identifiable future operating losses up to the date of restructuring are not included in provision. Any identifiable future operating losses which you have identified, that will not form part of the provision, that has to be expensed out immediately as per AS 29. Ind AS 37 gives an exception to this principle. Such losses related to an, they says yes, AS 37 also, Ind AS 37 also states the same thing, that any identifiable future operating losses up to the date of restructuring will not be included in provision, has to be expensed out. However, an exception to this has been given. They says any loss related to onerous contract, that can be shown as provision instead of recognizing it as an expense. So, as per AS 29, provision is to be made for even onerous. Provision is not to be made for any identifiable future operating losses on account of onerous contracts. But Ind AS 37 says the provision has to be made. The expense has not to be done. Expense, it should not be recognized as expense. You have to create a provision for onerous contract, but AS 29 says even for onerous contracts you have to recognize the expense if it is identifiable future operating loss. Appendix. This is another difference. Ind AS 37 gives guidance on, Ind AS gives more guidance, gives guidance on rights to interest arising from decommissioning, restoration and environmental rehabilitation funds. Sorry. They give guidance on liabilities arising from participating in a specific market-based electrical and electronic equipment. They gives guidance on levies imposed by government. They gives guidance on levies, liabilities arising from participating in specific market, rights to interest arising from decommissioning, restoration and environmental rehabilitation funds. However, AS 29 does not give such type of guidance. So these are the differences which are there in AS 37 vis-a-vis existing notified AS 29. We are left with one standard. In fact, we are left with two standards. One is Ind AS 38 and Ind AS 40, which we thought to be covered today. However, Ind AS 40 is having one difference, so let us cover that. Ind AS 38 I will be covering in the next mentoring session. Tomorrow again we are having a mentoring session for financial reporting starting at 11 o'clock till 1 o'clock. This mentoring session was scheduled on 5th April, but because of certain unavoidable reasons we have to reschedule it, and tomorrow that has been rescheduled from 11 o'clock to 1 o'clock. Where we will be covering differences from IFRS vis-a-vis existing AS. This, which I am leaving out in AS 38, I will be covering in next session. Right now, let me cover one difference, which is in AS 40 vis-a-vis AS 13. In AS 40 is on investment property, and vis-a-vis notified AS 13 accounting for investment. There is only one difference. AS 13 provides limited guidance on investment properties as per the existing standard. Enterprise holding investment property should account for them as long-term investments at cost. However, Ind AS 40 is a detailed standard dealing with various aspects of investment property accounting. It's not only AS 13 has given only one or two paragraph about investment property. As per the existing standard, enterprise holding investment property should account for them as long-term investment costs. This is the only treatment given for investment property. In this, since we are having a separate Indian accounting standard on investment property, so it is having detail, it carries detailed guidance, and it's not only dealing with at cost, it states many other provisions. This is the difference. Otherwise, we are not having any other spend because we are not having a separate standard on investment property. So difference is not there. Here, please take it, read it as Ind AS 40. It is not AS 40, it is Ind AS 40 vis-a-vis notified AS 30. For any guidance, further guidance, you can, before just moving to, sorry, this last slide, let's see if we have any query. Okay, we are not having any query, so please note my email ID, shilpa@ici.in, or Seema. You can also mail at seema@ici.in. Tomorrow's mentoring session will be conducted by Seema ma'am, Ms. Seema Gupta. So you can even call us at 0120-3045-916. This is our landline number, direct number. You can even call us on this mobile, on this landline number, and also mail us your technical queries or general queries at my mail ID or at seema@ici.in. Hope you have taken the maximum benefit of this mentoring session and will be fruitful for you for your preparation for May 16 examination. All the best and thank you.